Welcome to the Retiring Real Estate Investor podcast, where we will discuss how to defer taxes on the sale of your property, earning passive real estate income, and everything you need to know to go from active investor to passive investor. Join us as we interview passive investment sponsors, explore the journey of other retiring real estate investors, and share our due diligence process we perform to select passive investments. Investment advisory services provided by Insight Investment Advisors, LLC, a registered investment advisor. This podcast is only intended for clients and interested investors residing in the states in which we are registered to provide investment advisory services or exempt from registration. Please contact us to determine if the firm provides investment advisory services in the state where you reside. All content on this podcast is for informational purposes only and should not be considered investment advice. Material presented is believed to be reliable sources, and no representations are made by our firm as to another party's informational accuracy or completeness. Insight Investment Advisors, LLC and its representatives do not provide tax or legal advice, and nothing herein should be construed as such. Always consult with your tax advisor or attorney regarding your specific circumstances. Hello, everyone, and welcome to another episode of the Retiring Real Estate Investor podcast. I'm your host, Brandon Bruckman. And we have a return guest. I love return guests. We haven't done many of these, so you're the second return guest, and it's
wow.
Ruben is back with us. Ruben, how are you?
I'm fantastic, man. Thank you so much for inviting me back, Brandon.
Let's start here because I think things are a little bit different. There's some new things you're working on. There's some continuing things you're working on that are exciting. Maybe just top level, introduce yourself again to the audience and maybe walk them really high level of the things that you're working on.
Super fast. Yeah, absolutely. I got my start in raising capital for fourplexes. Did that for a minute back during the crash. Eventually got into syndication after taking a break and a vacation abroad for a year. So I didn't know how to raise capital for syndications and follow the correct laws and work with limited partners and learn all that part of it, the business and the regulations, etc. So eventually I started this show called the Capital Raiser Show and learned by educating myself from the best syndicators on the planet how they were raising capital, kind of dialed that in, raised some money for some apartment complexes, eventually got into developments. I have some developments that are doing really well, but then COVID happened. The rates started going up. Insurance costs in the Southeast they skyrocketed. And that business model, I was getting paid in equity. It was slowing down and I was running out of money. So I needed something that would pay me very well and allow me to continue to raise capital. But I also was trying to get my wife pregnant, so I needed benefits. And I found this company called Yrēfy. And I thought that they were a debt fund, but as I gather, they do something extremely similar, right? So we have a product that is a fund that helps people get into new loans on the student loan industry. And it's a lot of fun. We're really helping these people get into better loans, and it's extremely lucrative. We have an incredible marketing budget, which I love about any business that I'm raising capital for, because if they're driving all the leads to me, more the better as far as I'm concerned. So I've been doing this for about 6 or 7 months and I've raised close to 4 million. I think I topped more than $4 million, which is like almost what I've done over the last numerous years in real estate. And it just seems like it's getting better and bigger and faster. And it's very exciting.
No, that's awesome. That is a space that, on a personal level, I have a couple students who are delving in there. We're gonna have to talk about this after the show help them out a little bit. Talk to us about in pre-show. You mentioned that you're building a subdivision, which I find like one part fascinating and then like daunting, and like how do you do that? Talk to us about that, how that's going a bit.
Yeah, so I will caveat and say that I just raised the money for it. I'm not swinging hammers. I'm not talking to the city, right? So
no, they don't want me doing that either.
We have some really good friends that were very good at building houses, that built numerous, maybe like 100+ houses, and they didn't know how to raise capital, and we didn't know how to build houses. So we got together. We decided to go down the build to rent with an exit strategy of selling the entire subdivision as one commercial real estate asset to an institution. And we've built probably about I don't know. So we have 8 complete builds. I think close to 30 starts. The frames have gone up on about an additional 20. So it's a street, and then on one little entrance, it goes back into a subdivision, and there's about 92 houses back there, and then 8 in the front. So that should be built by 2026. It's a very crazy business. I mean, any little weird thing can go. Like, they did a core sample of Earth and found a bone, and then that all of a sudden stopped things. We had to do an archaeological study. So these weird random variables get in the way, and you just don't expect them. And every project is different. You don't know what kind of strange variable is going to get in there. And I think that frustrates a lot of limited partners, because they're like, what do you mean? Like, this is unforeseen thing. Like, didn't you plan ahead? And we're like, we did. We understood that there was going to be all these little things, like the price of lumber is going to change, the price of concrete is going to change, the price of insurance is going to change, the price of rents are going to change. And at the end of the day, you guys are going to make a ton of money. So be quiet and just hang on with us. This is going to be good. But yeah, when you compare it to a regular multifamily syndication, there's not quite as many variables. I mean, there's still toilets, tenants, termites.
Sure.
And, you got to deal with contractors that might run off with your money or things like that. But I love real estate. It's just not what I'm raising capital for at the moment.
How do you think about that? It's interesting to think about the limited partner's perspective in a deal like that, right? It's going to be, you said 2026, we're going to be done building. It's a long time to, frankly, not see any distributions, right? Yeah. How do you help them sort of think their way through that? How do you make them feel comfortable with, of course, there's going to be unforeseen things and we have to educate on that. But is there a general process you're helping the team through to just keep people informed about, yeah, we're pointing in the right direction?
Well, we got to keep them informed, but even before they get involved, you have to really look at their goals, because dirt does not cash flow, right? And if they're looking for cash flow, this is not the project for them. If they're looking for a back end equity spread and position, this is, right? So if you find out that the goals, there is less people that are interested in developments, they feel it's more risky, even though every single building in your city was built by somebody at some point in time, and it's a proven, tried business model, it's still a little bit freakier than something that you can grasp your hands around, which I think for a lot of other syndications is a lot more straightforward.
Yeah, it has to be the right person, right?
Yes, it does.
Got to understand what it is that you're getting into. It's really, really important. Talk a little bit about, we've talked about this before, maybe the state of, I know you're not raising capital for real estate right now, but maybe the state of affairs on capital raising. What do you see? And then I know we've talked a lot in the past about raising from RIAs. Any new discoveries there?
So we'll chat about both of those things for sure. Yeah, over the last couple of years, I've seen a lot of the people that I've interviewed, the syndicator buddies, they're mostly in commercial real estate, either in multifamily or hotels or developments or assisted living or self-storage or RV parks, stuff like that. A lot of them have bailed from multifamily and diversified into those other asset classes, or they're hanging on. And a lot of people are starting secondary businesses like a capital raising mentorship or CRM software development program, or something like that, to keep the lights on while they're surviving this period of time. And the people that were able to, so here's the thing, is a lot of people freak out about floating rate debt right now. All the syndicators that bought floating rate debt, they're struggling, a lot of them, but not all of them. I know some guys that they still, and have throughout, have chosen floating rate debt because they like that they can move in and out very quickly. And if their business model is strong enough, it's actually not horrible for certain people, but a lot of people, man, have gone down in flames. So I think people are either backing out completely or stopping or launching new programs. Or there's a few people that are still buying, actually, believe it or not. And they're doing well.
Big change.
Yeah,
Big
lots of
change,
changes. Yeah.
big difference from sort of where we were. What do you think is a takeaway for maybe LPs from that, right? Like I see a push and pull there of I'm scared. At the
Yeah.
same time, I'm also sitting on cash and I can't sit there and hold up my 5%, 12-month CD anymore because that's going to be going away too. So
Yeah.
like where do you see their mindset at this point? Are they towing back into the water? What have they learned through sort of this, let's say, this period of difficulty?
Yeah, the real estate limited partner, which is not my current avatar,
Yeah.
they are chilling on the sidelines.
Hmm.
Now, they're not if so here it's coming up towards the end of the year. There's an election coming. And I think a lot of people at the end of the year, if they have a lot of cash, they're not going to get the tax segregation or tax benefits if they don't invest. So
Yeah.
those guys may still invest, but damn, you better know who you're investing with because it's not the most ideal time. There are still some people that are crushing it. They're great. They're the guys with the Midas touch that everything they do is golden and they've never lost anybody any money or maybe slowed down on distributions or stopped, but still very lucrative. But those are few and far between. What I've learned from interviewing 300 people on
Wow.
the Capital Raiser show is that probably if I was going to be a limited partner, there's only a handful that really stand out head and shoulders above the rest.
Mm.
And if you know who those people are, you should invest with them if you need the cost, the cost segregation and the tax benefits. If not, then just maybe hang out for another 6 months to a year. Now, what does your money do in the meantime? I'm not sure. A liquid investment would be great. I wouldn't lock your money into an annuity. My
Mm.
current avatar is what we call Fred and Myrtle. They're older people. Sometimes they don't even have a computer. The only way we can find them is that they watch us on TV, right? Because they're not
Mm.
on LinkedIn. They're not on LinkedIn. And
Yeah.
they call me and they say, I'm tired of getting 4.5% on my CDs. And looks like the price on that is going down. So I
Mhm.
need to put my money in something relatively low risk profile. And if it's liquid, that's even better. Tell me about what you guys do. And so I'll
Yeah.
tell them about what it is that we do. And a lot of times they like us quite a bit because we have a huge marketing budget. We have like Larry Elder and Dave Ramsey endorsing us, and that sells a
Mm.
lot, right? If
Yeah.
you have good marketing, that helps so much.
Talk about that flip a little bit from sort of raising for some of these deals in real estate side and then to debt. And then you mentioned something really interesting in the show notes, raising a ton of money through like TV ads and radio. Oh my God, those things still work. That's
I,
amazing.
I don't know anybody that's using it. It's expensive to go on TV, right?
Yeah.
And people don't buy it a lot of the times. The nice thing is accredited investors, they're typically a little bit more savvy than non-accredited investors. So they don't give you too much of a hard time. They're just like, tell me about the deal. I'll
Yeah.
if I like it, I'll invest. But the non-accredited investor, they're the ones that get on the phone and they're just like, what is this thing? You guys shouldn't be on TV. And they yell at me. And I'm just like, okay. I immediately go to, hey, we can only work with accredited investors. And they're like, what's that? So I get them off the phone very quickly. But yeah, it's a fun industry, man. It's a fun time. And radio and TV certainly has been working for us. We have a multi-million-dollar marketing budget. And so we pay our endorsers. We have celebrity athletes, like Jay Feely, Tom Chambers, Shane Doan, and then there's all these radio guys, conservative radio guys like Sean Hannity, who interviews
Mhm.
Donald Trump all the time, and
Mhm.
people like that. But yeah, it works phenomenally. So I just answer phones and talk to people all day long.
Target market fit, right? And you're spot on. Like the client avatar you're talking about, they couldn't even tell you what LinkedIn is, much less
Yeah.
have a LinkedIn account. They have no
I
idea.
I do old school paper apps by mail. For some people,
Yes.
they're just like, I don't use a computer. I don't trust anything electronic. My identity has been stolen. I don't want.
Yeah.
I'm not emailing you anything. Can we do this by paper? I'm like, sure.
We can. The world still works that way. People have fax
Yeah.
numbers too. Like we can do it. We can do it still, and raise that way. Talk to us a little bit about. So how does a debt fund work? Like give us a little bit more.
All right.
insight into how that sort of works for
Yeah.
investors.
Yeah. 90-second version. We have a huge marketing budget. We place ads on the internet looking for people that are paying very high interest on their private student loans. We don't do federally subsidized loans or the ones that are forgivable by Biden or any future administration. They call us and they're like, hey, I try to refinance with my own company, which is typically Sally Mae or Navient or Nelnet, and they said no because I missed a couple payments. Can you help me? We offer them a 3.9% rate, very low interest. That's not where we make money, by the way.
Mm-hmm.
And then they have to prove to us their credit worthiness. And the way they do that is they make the proposed loan payment into an escrow account. And if they do that for 6 months, we'll send it for final approval. In the meantime, we reach out to their lender
Mm-hmm.
and say, hey, you guys have a loan, it's not performing. We would like to negotiate and settle it at 39 cents on the dollar. And you wouldn't believe me if I told you, but almost 100% of the time they say yes. Get
Mm-hmm.
this load off my books. I'm not
Mm-hmm.
receiving payments, and I don't feel like garnishing wages or chasing these people or doing credit collections and filing judgments. So they give it to us, we pay it off, we reissue it at 100 cents on the dollar to the borrower, accomplishing their goal, which is to refinance and go from like a $2,800 payment to a $1,000 payment
Mm-hmm.
on a $150,000 loan. And we know that if they pay this loan over time, even at a custom term, even at a great rate, we'll end up making 61 cents on the dollar. So we've been doing this for 8 years. We have a $100 million portfolio. We're exploding right now. We keep on breaking records on the capital raising side. We went from 8 million to 8.5 to 12.5. This month we'll probably do 10. Broke a record. So that's like 29 million in Q3 of 2024 in a time when it's supposed to be really challenging to raise capital. And I think for the real estate guy, it could be. Actually, it is pretty challenging because those guys, they're used to getting 17% return, and right now they're not getting that.
Yeah, it's just not there to be taken. So this is a very interesting business model. And talk about those motivations. Like, why would a lender sell that to you for 39 cents on the dollar when it seems like they could spend the time working that out and get whole again? Why do they want to sell it? What's their motivation?
Yeah, they're not in the business of getting. So first of all, the lending industry is very stubborn and unwilling to depart from the FICO-based model. So if you got a bad FICO, can't help you, period.
Mm-hmm.
We're one of the only non-FICO-based lenders. We do some of the same stuff, right? Debt to income. But what we do is we get them to prove their ability and willingness to pay by making payments on the proposed loan into an escrow account. We know after 6 months that they can afford it, and they're very incentivized to continue to make payments because they just went from like 17% variable down to 3.9 fixed on their loans.
Yeah.
And that becomes affordable for them.
Mm-hmm.
So they are never going to stop making payments because they don't ever want to go back to default because that is a tough situation.
Mm-hmm.
And a lot of times this is the only loan on their credit record that's like really hitting them and destroying them. So once we get that off, their credit score a lot of times skyrockets.
I
really
see.
Fun industry.
Interesting.
So why won't they heal? So here's another thing. If they did refinance, that would motivate strategic defaults from borrowers. And I talked to some borrowers, some loaners, some people that have loans, better said. And they'll say, like, so you're telling me I need to be in default in order for you to help me? And we say, yes, but we don't encourage that.
Mm-hmm.
But I've heard a number of people, even way back in the past, they'll stop making their payments so they can negotiate their own debt for a fraction of it. But that only works if you can pay it off cash or if you use one of these agencies that you have to end up working with for numerous years and they finance, or I'm not sure exactly how it works. But they make a ton of money. It seems kind of, I'm not sure. I won't say anything about those guys. They seem a little predatory to me.
It seems inefficient, to say the least. Maybe let's say that and leave that there. It just seems inefficient for everyone involved, right? The lender, the borrower. Why? But I kind of get some of the motivation of why you need to be there. You kind of need to confirm to me, like, you really can't pay this, right? Because the strategic default's a real thing. I mean, we saw that in 08. You're flipped upside down in your house and you're like, look, it makes more sense for me to punt, right? If you really kind of think about it that way. So this is an interesting space. And I hear you on there's an entire space here. There's a great business model here for you guys because there's a lot of margin of safety, right?
Yeah,
And
that
do
too.
you think about the investors as should investors think about themselves as like it feels a little bit like hard money lending to you guys to go and execute the business? How should they think about themselves in maybe the capital stack, or how do they play in as investors?
Yeah. So the way that we structured it, when we filed with the Securities Exchange Commission, we set this up as a promissory note offering. So our investors, they become lenders, we become borrowers, and we promise to pay them a fixed rate of return. We do a Reg D 506C, and we offer them 10 and a quarter on our 5-year, which outperforms the stock market for most of them who are tired of the volatility of that space, right?
Mm-hmm.
They also are a little bit freaked out by real estate because of all the toilet tenants and termites, et cetera. And they're certainly not going to invest in anything crazy like an IPO or an oil and gas
No.
kind of thing. So this is like one step above a CD and pays more than twice what a CD pays. It's right in their wheelhouse for that specific avatar.
Mm-hmm.
So they feel like it is a low risk profile investment because their investment is secured by collateral, and that collateral is our $100 million portfolio
Yep.
that we acquired at 39 cents, but is actually worth 100 cents. So they're like, how does this work? How is my money really secured? And we just tell them about the collateral. And if they can wrap their mind around student loans, which some people can't,
Yeah.
then it's a good fit for them because a
Yeah.
lot of people say, hey, there's $45 billion worth of distressed debt, 200 total private student loans, and 1.8 trillion altogether. And the price of tuition is going up. Nobody else is doing this. Yeah, get me involved. I want to be part of the ground floor on this particular opportunity.
Yeah, and okay, so that was my next question of if the asset or if the investment is backed by assets. The answer to that is yes.
It's secured.
Yeah, like that. Help me think about it is probably, and you correct me if I'm wrong, it's probably more economically advantageous for you to work that loan out at a special rate for that borrower than it is for you to say, seek to settle that in some sort of debt collection perspective. It's much more advantageous for you to work that out at a rate that works for that borrower, juxtaposed to maybe seeking to default on that loan.
That doesn't sound like a fun business model. So that's what our competitors do. They buy portfolios of non-performing loans, and then they chase the borrowers and file judgments and take them into court.
Yeah.
And that makes them money, but man, that's painful and doesn't provide a solution for anybody.
No.
That's just, and it's kind of predatory, man, because you're just like, you open up your door and here's a summons, you're going to court, you owe $35,000, and you're just like, why did I open the door? But that's what their business is that whole credit collections. It feels like you're, like the repo man, right? Yeah. So yeah, I'm not a big fan of that stuff. What we like about this particular thing is it helps the borrower tremendously. It gets them into a great loan and lets them restore their finances honorably. What we say is doing well by doing good. And it feels good to raise capital for a company that has some kind of altruistic mission. Yep. Like I was talking to Whitney Sewell, and he's a syndicator. He's got 700 million. Everybody's heard of him. He's got the real estate syndication show. Half of his money goes to helping people adopt, when they can't afford to adopt children. That's where a lot of the money goes to. And that's why he's so successful, because there's something else about his business model that's altruistic or philanthropic. And I feel like raising money in that kind of situation is peaceful and it feels good.
And there is value there. Like, this will sound like the proverbial win-win-win situation. That's a real thing. And there's economics for you as the company, for the investor that's coming to the table, and ultimately there's tremendous value for the borrower. You're putting the borrower in a better situation. That's a real thing. I think a lot of people don't exist. Are those your competitors though, that have sort of that, I'll call it a slimy sort of business model that doesn't feel good? Are those the people you're competing against to acquire some of these loans?
I suppose so, but I mean, they do something similar, but the only time that we'll refinance someone's loan is if they call us. Those guys, so we negotiate and pay off, cancel the loan. What those guys do is purchase the existing loan. That's a major nuanced difference though, because they own the original debt and they chase and hound borrowers. We pay that thing sucker off, right? Sally
Interesting.
Bays,
Okay.
Navient, they're happy because I think they only needed 10% reserves in order to do the loan in the first place. So I think they're still making 30%, believe it or not. Without, they won't make the 100%, which
Yeah.
is what they wanted, but they still invented money out of thin air. So I don't know how they can complain.
I explain that to people occasionally that banks and the like are able to and have a license to create money out of thin air, and some don't believe me. And then I walk through it, and you're onto it, right? The reserve balance only needs to be X on Y amount of loans, which is significantly higher. And you're like, oh, yeah, they can do that. They are literally creating money out of thin air. That matters though from an economic incentive standpoint. I mean, that helps to grease the wheels a bit for you guys to do what you do, right? Because they don't feel whole per se, but you're right. They're not in the business of working these loans out. It's much easier for them to continue to lend than to sort of work out these loans, right?
How do banks make money? A lot of them, they do loans and they make money off of the interest. All the mortgage bankers, those guys make a ton of money off just interest. So as soon as that interest payment stops coming in, that loan, it's just like a foreclosure. Like, let's get it off the books and move on, right? We're not in the business of chasing people. We don't want to take back any real estate in our business. They don't want to take back any loans or chase borrowers or do garnishing of wages and all of that stuff. They're just like, it's part of their business model. We understand that not everybody's going to pay. If we can get 98, 97% of all of the loans to pay, we're doing good. Just like an apartment complex. You got 99 people paying out of 100 in a 100-unit apartment complex. The whole thing performs very good. Some people are not going to pay. It's part of, the losses associated to doing business.
And those are all, excuse me, the student loans. I mean, those are non-recourse loans, right? So they're probably preparing for, higher loss level than, of course, a mortgage where you have an asset, correct?
So that's an interesting point, right? Student loans have no collateral except for the person's brain. However, they are bankruptcy protected, so they can't be discharged in a court of law. So that does mitigate the risk, right? Because you can't just erase your debts and have them go away magically by going to file bankruptcy.
Yeah. That makes working it out a little bit easier too, I would imagine, because there is no trapdoor here. You kind of got to pay. Sorry. So let's figure out a way to do it.
Yeah, if you're going to be stuck with the loan, wouldn't you rather pay 3.9 versus 17% variable? Yeah. And if you die, they go to your heirs, believe it or not. That's how crazy this is.
Yeah, now I'm thinking about the co-borrowers or the co-signers, i.e. the parents typically, right? Then they come knock on their door.
A co-borrower is literally a guarantor, right? And yes, that mitigates risk in this industry. 70% of our borrowers have a co-borrower. That helps a lot. I wanted to dive into the RIA world, man, because this thing's new to me. We have about 10 or 15 RIAs that we're working for.
Great.
We do a lot of direct to consumer on the TV, but we also are trying to get into this RIA world. And of course, anybody that works for a big brokerage platform can't accept any alternative investments or very few. And there's got to be a specific registered investment advisor kind of box that we're looking for, right? Which is like, hey, maybe 500 million or less of assets under management and open to, like, I get to underwrite or do the due diligence on the company that I want to sell to my investors, to my client database. And it's challenging to find. It's like finding a needle in a haystack to find that particular. You probably know. I don't know how much you talk about this on this particular show. But like, even for a real estate syndicator to find a registered investment advisor that will help them or sell their product is very rare, very, very rare.
Yeah, it's a real thing. I'm that person. So you're talking to that person. That is me. I'm the one who can make investment decisions for our firm. I fit that box. And frankly, there's just not a lot of us that are out there. However, the ones that are out there are starving for great product to put our investors in. They want this. And so, personally, and there's some of these folks have been on our show. We've looked at this similar business model across different assets. So we've looked at it for purchasing lots and subdividing those for residential purposes. that has a similar business model. We've looked at a fund and invested in a fund that does this with mortgages. Same thing. They're buying the mortgages or secondary mortgages from a bank, and they're doing the same activity. This is the same business model on a different asset class and student loans. I find it attractive. There are RIAs that find it attractive, but yeah, I challenge. It is hard to find us that are truly independent, first and foremost, and then two, that understand these things at a deep level, that they feel comfortable putting their clients into them. Right? It's almost like a 3-pronged step that you have to walk through to really build that, called an avatar of me. Right? There's a lot of levels to go down, because most folks, they're not sit in my seat. We have a tremendous amount of responsibility. I'm a fiduciary to my clients.
Yep.
Right. And so it's real. It's really real, right, of what we do. And there's a lot of fear drives the story instead of opportunity. And that's unfortunate. Right. So I don't know. I'm not helping you, but it is. I'm confirming that it's tough.
It's a fascinating kind of approach, right? Because so I just went to this nitrogen conference, and there was like 1,000 RIAs, and like 99% of them were big brokerage. But some of those, that 1%, that's what, like 10 people in the entire conference, something like that.
Yeah.
I think I found some of those guys. They're there, right? And that still takes a while. You still have to sell them. They still have to do due diligence. It takes a while to build these relationships, but it is a branch of our business that we're expanding, and it's fun, but it's challenging, and it does take longer, but it's worth it. I mean, could you imagine if somebody, like, we have a couple of guys that have raised $10 million for us, or that have promoted our product to $10 million worth of their clients. And man, that feels good. That feels good when you can have somebody that buys into your product, that's a registered investment advisor. So it's worth it. It's definitely worth it. It is a challenge, but we're going to keep trying. So I'm curious though, I know you're the one that's supposed to be interviewing, but how do these real estate syndicators or debt funds or private equity or private debt, what should they do to find people that fit this particular box? Any suggestions there?
Yeah, I think I've found a lot of, so the contacts that I have in this space, I found them through LinkedIn, right? And so that's the best. I think that's still the best way to kind of track us down a bit. And it's going to be difficult, right? Nothing on my profile says, hey, I get it. I'm an independent RIA. I'm cool with this. I'll do due diligence on your deal. There's nothing on my profile that says that. So it's tricky then to turn around and find us. So then it is a process of needle and stack of needles, so to speak. But I think if you we will find you if you post, great content about what you're doing in a very transparent way. You have great deals, or in your case, a business model that we can wrap our heads around, and it's producing solid returns, and you're good people, we'll find you. We'll find you eventually. That's sort of the way to think about it. And then, like, to add on to that, so the sort of the way we think about the funds or your business model in that perspective is we think about them as, from our perspective, we think about them as a bond alternative, right? Because we don't see much from that space. So some people in my seat will use this term like, what you're doing is an alternative investment. That's a loose term that doesn't mean anything to me. It means it's not a stock or a bond. That's about it, right? It's such a huge like catch-all bucket. But to us, what you're talking about is a fixed return with an asset-backed product in essence, right? It's a loan, it's debt. You've described it as such. It's a note. That's a bond alternative for us, right? And so if we can have that portion, we think about that in two different ways then, right? One, we think about folks that have cash and want to bring cash to the equation that may be traditional real estate investors, could be a great product for them. Or, and this would be really helpful for you guys and be really beneficial for you, it becomes part of the portfolio for all of our clients, right? Yeah. So we think about what we're doing from a management and asset management perspective. We got stocks, bonds, we have a system to run that. Let's splice this in there, right? Because it's sometimes for us in our systems, they may not be producing a ton of income. Like we may be out of the market. So if we have something else sitting here producing 9, 10, 11, 12% every year, part of that portfolio equation, that's going to smooth out the return pattern for our clients over time. Yeah. That's a huge thing. So if you can get people thinking that way from the RIA space, that can be tremendously beneficial.
There's not a lot of products out there. So one of the things that we offer is the ability to turn income on or off. I get a lot of people say, hey, can I compound for 3 years and then I'm going to retire and then I'm going to need income? I can switch it, yes. And I'm like,
Cool.
yeah, you could do that. You can switch it as often as monthly.
Hmm.
There's platforms that don't allow, they don't have the software to do that. So you're
Yeah.
instantly disqualified because you can't even get on their platform, and everything that they run, all of the business opportunities or investments, they have to go through that platform. So
Yeah.
that limits us some more, right? But
Yeah. And
people
that's
do
it.
want that income.
And that is an issue for, so operationally, there are some issues for us as RAs. So a lot of, and rightfully so, we're thinking about a couple of things. What's best for our clients, but what has operational ease for us as well, right? So if you're neck and neck with another product and I can custody that product at, say, a Schwab, I'm going to pick the product and custody at Schwab. I mean, that's where all our business is at, right? And so it makes my operational life easier. When I have to custody things away from Schwab, it makes my life harder. It makes it more expensive for our clients too, right? There's custody fees to do that. And so I think you'll get some RIAs are thinking about this process a little bit backwards and are thinking about, unfortunately, thinking about them and their operational needs first. And then frankly, what's really best for our clients kind of second, right? If it inconveniences their life and operations, they're not really interested in it. We don't really think that way. Like, we'll try to make good things work. But you're absolutely right. Like, getting onto the quote unquote platform for some of the RIAs is a really big deal.
That's good insight. Good stuff.
stuff we stuff we deal with on a sort of a daily basis. It is the alternative space for us is really fascinating. There's a lot of products that to us are very similar, and that gets frustrating, or they're very commingled and they're diversified, quote unquote. That's frustrating for us too, because it makes our due diligence a lot harder, right? So we prefer standalone. This thing does this. It acts like this in these types of markets. Awesome. Let me put the puzzle pieces together and put that with something else. Let me blend the cocktail for the client, right? That makes us happier, right? Then I get really nervous when we're like, hey, here's fund A. Well, what's in fund A? Well, a little of this, a little of that, but it's diversified. No, that's okay. No, thank you. That's tough for me from a due diligence perspective, but I don't think that's a popular RIA opinion. I think they'd probably think about it the other way.
Makes a lot of sense.
I don't know, maybe. I don't know, but I think it is an avenue. I think you're right though. Like, bottom line on raising from folks like us, I do think it's worth it. I do think there are folks like us out there, and I think it sounds like. I mean, not endorsing anything here, but like the business plan of what you're describing sounds very clean and very easy for people to understand. So I think it's going to be appealing to some RAs for sure.
Yeah, and we're getting more traction because we just hit that $100 million mark. Prior to that, I think we were just a little bit too small for a subset of the RIAs that we wanted to work with, and now we've hit that, and we're growing fast.
I love it. I'm going to spin you. There's a couple other things that Sean you want to talk about. So here comes the spinning. Spiritual philosophy. Okay, this is good.
I love spiritual philosophy.
Yeah, tell me about that. What does that mean for you? And then you made a comment about
a number of things.
How that works in business for you. Tell us about that.
Well, I think karma in general will affect you in terms of business, but a lot of my philosophy is based off of the works of, some people call it Eastern philosophy, but I just studied Wayne Dyer, right? So I didn't go to India and study those guys. A lot of what he talks about is very similar, but he talks about bringing and attracting peace into your life. So when you are choosing your business model and what you're going to do with your life, and you're trying to be successful, a lot of people will look at, well, how much money is it? And they'll evaluate, like, how challenging is it going to be to run this? And really what they should be asking themselves is, will this bring me peace? Man, because if you find something that does bring you peace, then you'll be able to weather the storm because you love doing it. And like, there's so many people that don't focus on that one thing. They're just like, oh, I'm going to start a fund because I know that's what all my friends are doing and they're having success and I got to be like them. And instead of just asking yourself internally, like, am I alignment with what God wants to create through me? And the way that if that's true is just by asking yourself that one question: will this bring me peace? and your intuition does the rest, man. So when I look at Yrēfy and what we're doing there, it brings me a great deal of peace. So I know I'm exactly where I'm supposed to be. The subdivision is a lot of fun, man, but that was very challenging to raise capital for a real estate development deal in a market that people didn't know. So now I'm a little bit, as if I get back into development, which I think I will, it's going to be in a market that people understand, and it's closer to where those guys lives. If all my LPs are in California, I'd much rather be in Phoenix versus Louisiana or Florida, right? And same thing for all the Florida guys. Don't sell them Phoenix if they're over there on that side of the country. But yeah, great marketing for fund managers, particularly if you got anybody listening that's a fund manager, you're going to want to raise for somebody that's going to want to help you. You have more rights and privileges in today's market because money is harder to find. And if you're bringing $500,000 up to 5 million, well, they better be doing your marketing for you. They better be including you. They better be helping you with the decisions, or, you better they better allow you to participate at a greater level, even though as a limited partner, a fund manager that strokes a limited partner check, that is, you're not supposed to have any rights, but you actually do. I mean, it's not just due diligence. It's more than that. And if they can provide you webinars, get on there with you, maybe even help you with the fund structure if you're doing deal by deal type stuff, I think you have the right to ask for a little bit more today if you're bringing that kind of capital to the deal.
Yeah, I would say you always do. If you're bringing capital to the deal, you have a hammer to swing, and you should swing it. It must be tricky. Can I apply that same sort of peace philosophy to who some of the capital raisers are picking to raise capital for, who they're picking to partner with?
Well, they're making a lot of mistakes. Well, some people are making a lot of mistakes, particularly the rookies. They'll do the same thing that I did. When I was looking to get involved with syndication, I said to my broker who I used to buy real estate, I'm like, anybody that syndicate? Oh yeah, I sold these guys a $5 million deal. Go talk to him. And I did, and I was like, I need to know who I need on my syndication team. And they're like, well, what do you care? I'm like, well, I used to raise capital for fourplexes and stuff. Can you tell me who I need on my team? I want to get into this industry. And they're like, well, really? What did you just say? You had a YouTube channel and raised money? We need somebody like that. Come work with me. And I picked the first guy that wanted me. That's such a mistake. And so now people call me and they're just like, hey, I got this guy I'm thinking about raising capital. I'm like, tell me about him. Oh, he's my friend. I've known him for 15 years. And I'm just like, oh, that's like already a bad situation. Right? If you're going to raise capital it's not the dude, your buddy from down the street. You go find somebody that's got an incredibly long track record and then go raise capital for them, because they're going to provide you all of this stuff that's going to make your job easier, like the marketing, like the webinars, like the website, like the track record. And this dude down the street that's your buddy that's working on a second syndication, they're not going to have any of that stuff.
Yeah.
But they're like, so they don't contemplate that stuff.
Stresses me out just thinking about it.
So here's the other thing that drives me crazy. Because I have a lot of family members that do this. They go to church and then, they're all about like reconciliation and being a good person in church. And then as soon as they walk out of the door, they're like an asshole. Sorry for my language. Like, they don't talk to their kids. They hold grudges.
Yeah.
Is not in alignment with God. So just because you go to church doesn't mean that you are a good person.
Yeah.
So that kind of stuff drives me crazy. But my number one philosophy is the golden rule. Do unto others as you would have do unto you. And just be a good human being at all times, not just when you're in church. And if you can do that, then the universe will conspire on your behalf. That's my spiritual philosophy.
Sounds pretty easy, but it's hard in execution. We don't see a lot of it. Yeah, we talk about here. And in my quick story for me too, in my personal development, spirituality was the missing component. Like, I ran through all the sort of self-help stuff. I did all that. Influential books were really key. Ego is the Enemy, Ryan Holiday stuff, Think and Grow Rich. I did all that, but something was still missing. It was a spirituality component. And so to your point, we talk a lot in our house about that hour a week that we're at church. That's the minimum requirement. Right? We got to do a lot more on the spirituality front than that. At the very least, we're hitting that, but boy, oh boy, yeah, that's not good enough. If that's all we're doing, I mean, I don't think that's 1 hour of your entire week. That's not going to work. We need more.
Yeah. The other thing is too,
personally, you need more.
So I have a degree in chemistry. I know that everything is made up of energy, and energy attracts stuff like a magnet does, right? And if you're out of alignment with God, you cannot attract the right way. So that's why it also makes a great deal of sense to just be a good human being all the time, because if you're in alignment with God, then he creates through you at a much higher, easier level versus you blocking that stuff by, any number of things, whether it's self-abuse, which a lot of people have, right? So a lot of people that are becoming successful or are in the path of success, they have a little self-sabotaging agent part of their personality, and it's like two things going on simultaneously. Yes, I'm a fund manager. Yes, I'm a syndicator. Yes, I'm an RIA. Yes, I'm a whatever. But there's this other voice in my head that says you're not good enough to be that. Like you're an imposter, you're a cheater. This is not true. You don't deserve this. You're not worthy. You got issues from your childhood that you still arise, and you have to deal with all of that stuff, your inner kid, and make sure that they're healed. But at the end of the day, yes, the number one thing is you got to be a good human being in order to attract the right things. You can't just be like a great person and then cheat on your wife and then expect good things to happen for you. It just doesn't work like that. So
my mom used to say in a yelling sort of way, I think this is the way she used to say it, like, do the right thing because it's the right thing to do. She's right. She's like angry about it too, which was kind of a funny way to say it. Right. Ruben, this has been really fun. Where can people find you? Where should I point them to? Where can they go?
So LinkedIn is probably a good spot. You can reach out to me there. You can find, if you are interested in Yrēfy, you can find us at investyrēfy.com for all the investors, or just Yrēfy. That's Y as in yellow, REF as in Frank, Y as in yellow.com. Or you can, check out my friends at Legacy Acquisitions. We're doing the subdivision together. If you guys are interested in real estate and development, that's a really cool business as well. And you know what? Quick shout out to the Capital Raiser Show.
It is.
Yeah, come hear our episodes. We've interviewed tons and tons and tons of people that have incredible insight for raising capital.
Yeah, I was gonna add that on the end. Like you mentioned, you interviewed 300 people. Like there's some things there to learn and to pick up on that people should be listening to. That's a body of work, Ruben. That's a body of work that's been put together. I'm jealous. I want 300. We'll get there slowly over time. Thank you so much for your time. This has been awesome. And thank you everyone for listening. Until next time, take care.